WTI, 75.88. Rebecca Babin, CIBC Private Wealth Senior Energy Trader and Managing Director, joins us this morning. Rebecca, good to see you. And we have been kicking this around and, with different oil analysts. I have argued that markets are all-knowing. Others say that oil gets fooled just like anyone else with the fits and starts of is there a deal, is there not a deal. This time there was a lot of skepticism about it, whether anything was going to happen, but the minute Scott Bessent said a deal was close in the next day or two, it went from 85 basically to 75. Does oil get fooled, or is it the real arbiter of whether something's likely or not?
So I don't think oil gets fooled. I'd kind of fall closer on your side of this, Joe. I think what oil does is react very quickly to headlines and extrapolate them out. Now, what you're implying is that, this is going to happen. And that's what the market is essentially pricing. As soon as Bessent came out and said there was a deal in the works and it was close, the market repriced a higher probability of that deal. And the market has been effectively trading on this narrative headline. Now, has it had to revert back when the narrative shifts? Absolutely. But I don't think it's fair to say the market's being fooled. I think the market very quickly reprices to the risks it sees on the horizon. What I would say the market does is price this on a very short-term window, right? So we're pricing that this deal is likely to come into fruition over the next coming days, and we see flows go right back to that 70-80% of pre-conflict levels. That's probably an optimistic view, but in the window of trading and having to trade a commodity that's reacting to narrative, you can't be the last one trading the fundamental view when the narrative has shifted. You need to immediately go from pricing scarcity, we're missing barrels, how are we going to ever replace our SPR and inventories, to we're moving into a surplus. So it's a short time horizon that you need to be, that the market's working with. And I think that's where the mismatch that we're talking about is. The market is trading on a very short time horizon here. Deals coming, we're kicking the can down the road, we don't have a supply risk. Whereas maybe when you talk to analysts and fundamental view, they're taking that longer term horizon. What does this mean overall? How long will this last? And that's where I think you're seeing this kind of, where is it the market or is it the analysts? I think the market's just trading a way shorter time horizon than the analysts are.
I think one of the other assumptions, and I don't know whether it's right, but it's one that I've thought might be right, was that things were fairly well supplied through all of this. And another oil analyst we had on said that was because of the wild card of China, no longer stocking inventories, and so that we could have been much higher if they continued to import whatever X amount instead of 5 million less than what they're importing. And I would have thought spot prices could have been, I don't know, the thoughts were it could be $150. Why didn't it ever go to $150? It's half that. Why?
So you're hitting on the first key point, which is China. China has been the best crude trader in the market over the past 2 years, hands down. Last year, they were taking every barrel they could and putting it in SPR. They built their SPR by 360 million barrels to 400 million barrels, depending on who you asked last year. They have just started drawing that down throughout the conflict. And what they didn't do is China did not chase that replacement barrel, which is exactly what you're talking about in the spot market. They didn't go out and chase the replacement barrel. They drew down some of their stockpiles. They shifted their demand profile. They used more coal. They did a lot of coal to crude switching. The EV sales increased. So that was one huge factor. A second factor is we have seen a lot of non-OPEC supply growth pick up, whether it's Brazil, Guyana, Venezuela, the U.S. to a lesser extent, and Canada. So we've had that come into play as well. And then you had the SPR releases, which was the third buffer that kind of fell into place here. So there was a number of factors. And let's not forget one other key factor. There were a lot more ships moving through Hormuz through the conflict than I think were reported or well understood. UAE is said to be back at pre-conflict production levels right now. They are finding ways, even right now to this very day, when tankers are being targeted, to get ships through. So workarounds were a huge factor as well. So all of those things came into play and kind of took that 150 barrel kind of worst case scenario off the table for the market. But let's be careful. If we revisit military conflict, we're in a place where we have far fewer buffers than we did before. So if things go wrong from here, the safety net is not in place for the market. And we're actually at more risk of seeing that potential upside tail if things go wrong. Now, the probability of things going wrong is obviously reduced as diplomacy seems to be the first choice. But I think it's worth noting that a lot of those cushions that we had that kept us below those worst case scenarios have been eroded at this point.
Right. Yeah, but Iran better watch it though, because it's not always going to be the world. Nature finds a way. That was in, I think, Jurassic Park or something. I mean, we will find something besides the strait if they don't watch it, and then they'll have no influence, because oil just seems like, you say it's ready maybe with no buffers, but it seems top heavy to me. It seems like it wants to go back in the 60s if it got half a chance. I don't know. You're the oil expert. I'm not.
Well, I think that's a fair point. I think if you look at the way traders are positioning and you look at the options market, downside expression is where the kind of juice is. And
Really?
the way we get to this, yes, absolutely. Hedge funds are trading for that downside move, particularly in 2027. That's on the assumption flows resume and we go into a surplus in 2027. And that's where you need to start thinking about, that $60 scenario. But we need to get through here to get to there. And I think that's why we're still looking at a market with geopolitical risk premium built in.
All right, Rebecca, thanks. Appreciate it.
Thank you.
Okay.